excited to be here today and give you just a quick overview of the downstream environment that IHS Markit is currently seeing, not only in the near term that affects the refining, the petrochemical industries, but also some of the longer term trends that perhaps I won't be around to fully experience, but many in the audience will see longer term. Many of these are generational, they're behavioral. We'll talk about the way people use transportation in particular, and it's a very exciting time to see these changes taking place in the industry. Just a little bit of background on IHS. We are, as my own experience confirms, have grown by acquisition of many companies over the years. Kind of cover the range from economic analysis to the automotive industry to the shipping industry, and a big focus on energy, upstream, midstream, and downstream, and the chemical industry. Again, we work very closely with most of the companies here in the room, and appreciate those relationships, and work very hard to stay current and stay relevant and really bring in a very wide experience and resource base across the entire economy. So just some of the themes we'll be going through today. First, crude oil markets, what's happening with crude supply and demand and pricing, where we see prices leveling out, and then get into some of the key drivers on the crude oil markets, which is what's happening with liquid supply, particularly in North America. Very exciting time technologically and economically, with a lot of very beneficial impacts on the refining and petrochemical industries. Got a very quick shout out to the IMO bunker sulfur program that we're expecting to be implemented in 2020. We've got a full panel later this morning which will cover it in depth, but I'll highlight some of the key issues. And then finish up with going into some of these long-term trends that are changing the way that people achieve mobility, whether it's through personal transportation, whether it's through other forms of transportation. But we're seeing very interesting changes in technology, changes in mobility behavior, which we expect to have an impact on the structure and the nature of the automobile fleet, with significant impacts on fuel consumption as these trends play through the market. So let's jump into crude markets here. Of course, everybody wants to know what the price of crude is going to be. I wish we had a perfect crystal ball. Ours is as cloudy as most people's, but we have spent a lot of time analyzing the crude oil markets. If you look back over the past, 15, 40, 65 years, what you'll see is that there have been about five, significant periods of, portions of cycles. We've had a long stable period in the 60s as Middle East supply built up. Prices were in current dollar terms, or in today's dollar terms, roughly $20 in dollars in the day, $2 to $3 to $4 crude oil prices. The 70s saw a significant increase in crude prices, with first the aftermath of the Arab oil embargo, then the aftermath of the Iranian Revolution. Got up to $100 in today's dollars, which led to significant economic slowdown throughout the world, very significant changes in consumption behavior, and a price collapse that started slow and then accelerated in the mid-'80s. And persisted for about 15 years, so a long period of much lower crude prices. Prices did ratchet up a little bit from where they were in the 60s, but still much lower than during the peak of the shortage years. And then starting around 2000, we kind of hit what the bankers call the super cycle, where you had about a 15-year period of fairly steadily rising prices. We attribute a lot of this to the development of the economy and consumption in China in particular, but also the rest of the Asian markets, where they really took the momentum away from the more developed regions and drove the crude markets. Since 2014, we've been in the down cycle, which we're calling the shale era, because much of this has been driven by the tremendous success of tight oil and shale oil producers, primarily in the United States. The success was driven by the technological advances and the high oil prices, but contained the seeds of this price decline. So now we're back down in the $40 to $50 range at the current time. But the key takeaway from this is that cycles don't tend to be here one day and gone the next. They tend to last, or the significant portions of the cycles tend to last 10 to 15 years. So we're 4 years, or a little less than 4 years into the current shale cycle. The question is, how long is this going to last? Is this year 4 out of 15, or is this year 4 out of 5? It makes a lot of difference. We think the pattern is going to be somewhat different this time around, and primarily because the overall conditions in the oil market globally are very, very different than they were, say, in the 1980 to 1998 down cycle. If you look at back at that time, starting in 1980, product demand, crude oil demand was dropping every year. And over a 4-year period, roughly 6 million barrels a day of total consumption was lost. What that did was add to excess capacity. So by the end of 5 or 6 years into that cycle, the world had 10 to 12 million barrels a day of excess crude oil production capacity. So a very, very ugly, slack market, which took a long time to get back to balance. If you look at the current cycle, we're nowhere near that condition. Crude oil demand is growing at roughly 1 million barrels a day, and has been for the past several years. We anticipate that will continue. Total global excess capacity is in the 2 to 3 million barrel range. It's staying fairly steady, primarily because of the continued advances in production technology, much of which is here in North America. But the fundamentals that balance the market, this interplay between growing consumption and excess supply, are much more positive in the current market. So we think we're going to see a shorter cycle. Again, we're not going to see the 15-year cycle. We think it's going to be a shorter cycle. You've got some impacts of the IMO implementation that we think help bring the current weak period to an end. So we kind of look at the crude oil market in 3 different periods. Between now and 2020, we've got a fairly weak era of something in the $40 to $60 range, very volatile, lots of ups and lots of downs. Between 2020 and 2025, we get into a stronger market, again helped by the IMO demand boost and by tightening fundamentals. Longer term, past 2025, you look at what does it really take to provide the hydrocarbons to supply the world's need for those fuels and petrochemicals, and we think the number is somewhere in the $80 range in today's dollars. This is to keep the deep water coming, to keep the oil sands coming, to keep the shale moving along. So we've got sort of a week and then a recovery and then a long-term plateau. Let's jump into the U.S. In particular. I know that this is an international conference, but I know there's also a very strong North American focus on it, and America's focus. So if you look at the engine of growth in the oil market in North America today, it's Permian. The advantages of the Permian resource base, when coupled with the tremendous growth in technology and implementation skills of extended reach horizontal drilling, multi-stage fracturing, the Permian is a target unlike any of the others in the world. You have a huge aerial extent. You've got a huge vertical extent as well. Thousands of feet of play of reservoirs that have not been economic in the past, but using the advanced completion techniques, they are available. So you see some very, very aggressive numbers for the long-term potential of the Permian. We get up to about 4 million barrels a day, and our outlook, I've seen numbers twice that. So You couple that with a location in a very technologically advanced market with plenty of market access, access to export facilities. So the Permian is really a tremendous resource, and we see that as the driver of future growth. We've continued to have growth in Eagle Ford and in the Bakken and Niobrara and some of the other plays, but the Permian is by far the most important. So as production of these unconventionals has grown, we've seen very, very rapid increases in crude oil and condensate exports from the U.S. to other markets. It's very interesting to look at the change between 2016 and 2017. In 2016, about a little more than half of the condensate and crude was going to Canadian refiners. With the expansion of production, particularly in the Permian, it's really shifted around to Asia, where now the Asian markets are, through the first part of 2017, have been taking more crude and condensate from the U.S. Than Canada has. And we see this is really a long-term trend that's developing. We'll see more and more Asian refiners, Asian petrochemical producers taking feedstocks from the U.S. as the infrastructure develops, as the pricing becomes more and more advantageous to them. Excuse me. Long term, I said we've got a very, very bullish outlook on U.S. supply. We have tremendous growth in crude production. We've got in North America, we've got significant access to Canadian crude production. We will continue to have some small amount of offshore, actually a pretty large amount of offshore imports, but largely offset by our exports. But when you look at our overall hydrocarbon balance, including crude production, NGL production, biofuels production, refinery process gain, somewhere out about 2025, the U.S. actually goes into a net surplus of liquids. So it's been a long time since Jimmy Carter's Project Independence, but we may actually get there in 2025 or so. If you look at the configuration of the U.S. refining industry, the fact that it's spent billions and millions of dollars over decades to increase its capability to process heavy, sour, very difficult crude feedstocks, it doesn't make sense to throw all that away and start running 40 gravity crude from the Permian Basin. We don't think that's going to happen. So we'll continue to see a very large volume of heavy crude imports into the U.S., primarily into the Gulf Coast, to some extent to the West Coast. That'll be more and more sourced from Canada as the oil sands continue to develop, which we think continues to be a very, very significant part of our supply. In addition to the oil sands, we've got heavy crudes from Latin America, some heavy crudes from the Middle East that will continue to come in and really supply the need of the refining industry for those heavy and difficult feedstocks. Very, very small amounts of sweet crudes coming in, a little bit on the East Coast, a little bit on the West Coast, but generally a pretty minimal amounts. And so as we have a slowly declining total import volumes coming into the U.S., we'll see more and more of those volumes being accounted for by the heaviest feedstocks. The NGL production is tremendously exciting and creates many opportunities for everybody in this room. This is our just total production in the U.S. So we've got had a long slow decline that ended about 2010 with the growth in unconventional crude production and associated gas with the growth in unconventional gas production, much of which is fairly dry, but a lot of which contains significant amount of liquids. We've completely turned that around, and so since 2010, we've been on a very, very steep upward slope of total production, and we don't see it peaking anytime until well after 2025. The amount of gas that's being found, developed, again, the exports of LNG, the access to the export markets for LPG and NGLs, are very, very key to providing the economics to keep those resources being developed and being brought to market. So, very, very bullish outlook for NGL production. You'll see the ethane has some little waves and peaks and valleys in it. That pretty much follows along with the startup of new ethane cracking capacity. where we see as the market develops for that ethane, that'll stop being rejected, it'll start being recovered and come back into the market. So you see that ethane consumption tracking right along with domestic consumption or production tracking right along with consumption and the amount of exports that are already started to flow. And speaking of exports, the U.S. has really entered a new era on the NGL side. The U.S. is now the world's largest exporter of gas liquids and LPG, bigger than Saudi Arabia. Many of us thought we'd never would never be able to say something like that throughout our whole careers. But we've moved from being a pretty significant importer of LPG to the world's largest exporter and a growing exporter. So one of the biggest capital inflows into the midstream industry over the past few years has been continued build out of the export facilities on the Gulf Coast for ethane, for propane, for butane. Again, those are growing like crazy, and the market is very, very eager to soak it up. And so what it means for all of us here who focus on processing those hydrocarbons are very, very many positive messages. There's plenty of crude oil supply. It's available at export parity prices, which are highly advantaged relative to much of the world. We have very, very abundant gas supply, very reasonable gas prices, that reduces our cost for thermal energy, reduces our cost for power, and particularly reduces the cost of hydrogen. Very important for all those heavy crude processing refineries. And this ethane volume will continue to fuel a surge in olefin capacity. We've got one wave that's starting up here over the next few years. We think there's sufficient ethane for the second wave, and we think we'll start to see announcements as companies look into those opportunities here over the next 3 to 4 years. One byproduct of all these crackers is a lot of byproduct hydrogen, so we'll continue to see very advantageously priced and available hydrogen for the entire refining complex. Okay, move into economic growth and demand. So we've talked about supply. Let's talk about what's going on in demand. So again, the supply outlook is, from our view, very, very optimistic, very positive. Demand is where you start to get the long-term questions. So if you go back over my career, we've been through periods of time when people were worried about shortage, people were worried about peak oil from a supply perspective. I tend to look at it as an economist, say if there's a demand, if there's a price, the demand and price will get together and result in the supply. And that certainly is what has happened. But as you'll see through the slides here, the concerns about peak supply, which have completely disappeared, now have a legitimate counterpart, which is the view of peak demand, which we think we will get to peak demand. The question is how soon, what drives it, and how significant is it? Just looking at our economic view, we've got about 3% growth, a little under 3% growth globally over the long term, holding quite steady. But in a sense, we're decoupling oil demand growth to some extent from economic growth. And so the energy intensity, the amount of oil that's used, per unit of GDP, has been declining quite steadily over decades, and we anticipate it will continue to decline. And so as economic growth holds fairly flat, economic or growth in oil consumption tends to decline year on year, still growing until it hits a zero line and starts to decline. And that's the point where we hit peak demand. When you look at where in the world the growth is occurring in oil demand, as in economic demand, it's primarily in the sort of the broader East to Suez region, China, India, the rest of Asia, the Middle East. Africa's got actually very, very strong growth in terms of percentage growth, starting from a fairly small base, and so the total volumes are not so small. But we'll continue to see the same pattern where the Asian markets are leading the rest of the world in terms of economic growth and energy demand growth. And so if we look at our long-term crystal ball for refined product demand, we anticipate continued growth out through 2040, that 11 to 12 million barrels a day of incremental product demand between today's market and that market out in 2040. Now, if you go back, the past 15 years, the numbers would be larger. If you go back to the past 30 years, the numbers would be larger. And the reason is this long-term plateau that we achieve. Somewhere out in the 2030 time frame, the growth hits a very low rate, starts to plateau, and then eventually bends over. We'll talk about where that's coming from, but much of the growth, much of the volume of oil demand now is in the transportation market, and these long-term trends in transportation technology and personal mobility are really driving this slower and slower growth and then decline in gasoline and diesel demand. So on the right-hand side, kind of break it up by region, you'll see that North America and Europe are becoming less and less relevant to the world's growth story and less relevant to total demand. The Asian markets, the Middle East market, will continue to increase their share of total oil demand and total energy demand. So just focusing on the U.S., we've got an initial, view on some of these long-term trends in terms of gasoline demand. People, over the past couple of years after the decline in crude prices in 2014, we had a very sharp stimulus effect from that lower price. And so 2015 and 2016, both showed strong growth in gasoline demand, strong growth in vehicle travel, but it's really turned around in 2017. When you look at how much people have been driving, the U.S. we're very fortunate in the U.S. in that these statistics actually exist. It's very hard to find these outside of the U.S. But the statistics on vehicle miles traveled have been showing that 2017 is weaker than 2016. Again, we've got a strong economy. We've got reasonable gasoline prices, high levels of employment, low levels of unemployment. But this stimulus effect that we had from the sharp drop in gasoline prices has pretty much played out. So now we're getting back to the fundamentals. We've kind of winnowed out the stimulus effect. And really, for most of the year, we've had vehicle miles traveled negative on a 12-month trailing average basis or a year-to-year basis. So our view is that 2016 gasoline demand will probably end up being a little higher than 2017. Have we finally crossed the peak and we'll start down? We'll see, but we think we're just about at that plateau for the U.S. And that's what our outlook calls for. A peak in gasoline demand in the U.S. roughly in 2016, perhaps in 2017 if the summer surprises us. But longer term, going from a period where we had a lot of volatility to a fairly smooth long-term decline, half a percent or more of year-to-year growth in gasoline demand. So the overall product demand, as I said, is dropping at about 0.7%. Much of that drop is gasoline, which is the lower bar. I think if I get this right, yeah, the lower area here. Diesel demand is much more stable. The jet fuel is actually growing, but these changes in gasoline demand are really quite important. And the thing that's driving these is the change in the composition of the fleet. We continue to have growth in the number of cars in the U.S., number of light-duty vehicles, but we'll see more and more penetration from hybrids, from battery electric vehicles, from other types of propulsion systems other than conventional engines. Okay. So we'll do a quick look at the IMO, and again, not trying to foreshadow what the panel's going to be saying next. But just to set the stage, the IMO, the International Maritime Organization, adopted back in 2008 a long-term program to reduce the sulfur level in global bunker fuel with an implementation date for a 0.5% spec either in 2020 or 2025. Last October, the committee had a meeting and much to our surprise and many others decided to go ahead and do it in 2020, not 2025. It was based on a study that was done at that time, which We're not sure we agree with it, but that's the decision. You have to look at this bunker change, in the context of all fuels. We've had sulfur levels being reduced from gasoline, from diesel, from all fuels around the world, for decades now. We're down, in ultra low sulfur levels, throughout North America, throughout Europe, throughout the developed countries in Asia, many, Latin American countries, many parts of China and India. But the difference between desulfurizing gasoline or diesel and desulfurizing residual are, transformative. They're two different animals. You can desulfurize gasoline, you can desulfurize diesel. It costs you money, it reduces your yields a little bit, but it doesn't turn the refinery upside down. On the bunker fuel side, it's much more disruptive because of the cost and even the availability of technology. So we anticipate that we'll have what we call a scramble period, where we'll have some very discounted prices for high sulfur materials. You've got to force that into alternative markets like power generation. You're going to have very wide spreads on high sulfur, low sulfur fuel oils, elevated prices for the 0.5% fuel or the IMO fuel, as we're calling it. All this is eventually going to go away because the shipping industry, in our view, is going to build the equipment over time to absorb and continue to use the high sulfur material. But in that 2020, whether it's 2 years, 3 years, 4 years, our panel, everybody's got a different view on that. During the scramble period, you'll see some very disrupted markets, very interesting economic relationships emerging. The hybrids, which are a combination of an electric and a gasoline or diesel engine vehicle, take a bigger and bigger share. Battery electric vehicles, as the cost of batteries continues to decline, take a bigger and bigger share. And then we've got some penetration by LPGs, by natural gas, pretty small though. But really the biggest piece is the various forms of hybrids, the various forms of electrical vehicles that reduce the share of the total fleet for conventional gasoline cars down to about roughly 50% by 2040. So that's the long-term view. It's fairly pessimistic for gasoline demand. Again, very interesting connotations for chemical demand, particularly the chemicals that go into building vehicles, which will change dramatically over the coming years. In the near term, we're going to have a continued volatility in crude markets that we have all gotten, maybe not gotten used to, but come to expect. In the U.S., the growth of supply will continue to create tremendous opportunities for the refining industry and for the petrochemical industry. Not so much fed on refined product demand here, but fed on refined product demand in those parts of the world that are growing.